What are the characteristics of the relationship between stocks and commodities across different economic scenarios? The relationship between stocks and commodities fluctuates depending on economic conditions, monetary policy, and market sentiment. Here are four key scenarios and their effects illustrated with historical examples. First, the economic growth or risk-on scenario. There's a positive correlation between stocks and commodities. When the economy expands, demand for raw materials rises, driving commodity prices higher. Equities, especially cyclical sectors like energy, industrials, and materials, tend to benefit from this increased economic activity. Inflation remains moderate, and central banks often maintain a neutral stance. For example, in the mid-2000s, the commodities boom from 2003 to 2007 was driven by strong global GDP growth, especially in China. There was rising demand for oil, metals, and agriculture commodities. Crude oil surged from $30 per barrel in 2003 to over $140 in mid-2008. Stocks performed well, particularly the energy, industrials, and materials, which benefited from the commodity price inflation. The S&P 500 in general experienced steady gains, supported by low interest rates and strong corporate earnings growth. What about the second scenario, market crisis, or what's happening in a risk-off environment? During financial crisis, investors shift toward safe haven assets like US treasuries and gold, while equities and industrial commodities decline. Demand destruction leads to collapsing commodity prices as economic activity contracts. For example, in the 2008 financial crisis, the collapse of Lehman Brothers triggered a severe credit crunch, causing the S&P 500 to plunge by nearly 50%. Oil prices, which had peaked at $147 per barrel in July 2008, collapsed to $30 by early 2009 due to recession fears. Industrial metals like copper also plummeted, reflecting weak global demand. Gold was an exception, rising from $700 to $900 per ounce, as investors sought a safe haven. Let's highlight now what's happening during loose monetary or accommodative monetary policy periods. When central banks cut interest rates or engage in quantitative easing, QE, asset prices, both equities and commodities, often rise due to liquidity injections. The dollar weakens, which supports commodity prices, particularly gold, oil, and industrial metals. For example, in the post-GFC Great Financial Crisis period from 2008 to 2015, which can also be labeled the QE era, after the 2008 crisis, the Federal Reserve implemented near zero interest rates and multiple rounds of QE, three in total, flooding markets with liquidity. The S&P 500 entered a decade-long bull market supported by cheap money and corporate earnings growth. Commodities initially rebounded in 2010-2011, with gold hitting an all-time high of $1,900 per ounce in 2011, which was only topped later again in 2020, but later declined as inflation remained subdued over the course of the decade. The strong US dollar due to Fed tapering in 2013 to 2015 weighed on commodity prices, particularly oil and metals. Let's now talk about the special case, stagflation. Commodities usually outperform while stocks struggle. Stagflation is characterized by high inflation and stagnant growth, leading to poor stock market performance. Commodities, particularly oil and gold, tend to perform well as inflation hedges. For example, after the COVID-19 pandemic, we experienced in early 2022 an inflation surge. The initial pandemic phase in early 2020 saw stock markets crash. The S&P 500 fell around 35%, while gold spiked above $2,000 per ounce due to economic uncertainty. As economies reopened, supply chain disruptions and fiscal stimulus led to a surge in commodity prices in 2021-2022. On top of that, in the geopolitical realm, new challenges arose. Oil prices soared past $100 per barrel in early 2022, while food and industrial metal prices climbed, fueling inflation. Equities, particularly growth stocks, struggled in 2022 due to high inflation and rising interest rates. To wrap up this section, the relationship between stocks and commodities is highly cyclical and dependent on macroeconomic conditions. During economic expansions, both rise together. During crisis, commodities, except gold, collapse alongside equities. During stagflation, stocks struggle while commodities thrive. And during loose monetary policy, both asset classes can rise due to liquidity-driven growth. Understanding these dynamics is crucial for intermarket analysis and sector rotation, as you will hear later, as it helps investors anticipate shifts in the capital flows and allocate their portfolios accordingly.